Hey, what's going on, everybody? Definitely want to go ahead and switch it up real quick and just kind of talk about things that you honestly just never want to do when trading stocks. And so I'm just going to go ahead and get right into it. These are pretty much things that I see new investors do all the time. And, in these last 2 years, there have been more new investors in the stock market than ever in history, pretty much. You just had an influx of young people, new people, whatever, coming into the market, especially with the growing popularity of Robinhood and how easy they make it to trade stocks. I mean, if you look, there's actually a video by Warren Buffett where he pretty much talks about and says that, no, actually it was Charlie Munger. I'm sorry. There was a video with Charlie Munger and Warren Buffett, but Charlie Munger basically said that Robinhood is not a respectable business. What they really are is a gambling parlor. I'm not sure if I would go that far, but what I will say is Robinhood definitely appeals to newer and younger investors, and so I just wanted to go ahead and get into a couple of things that I see new investors doing and kind of some things that you just don't want to do, some things that you honestly should just never do when trading stocks. And so I'm going to go ahead and get right into it. And the number one thing is buying stocks blindly. So what I often see is with new investors, what they'll do is they'll find their favorite stock YouTuber or Twitter influencer, whatever. And whatever stock or the latest stock that person posts, what new investors do or young investors do is they'll just hurry up and buy it. Without doing any type of research, not looking at any financials, didn't go to the company website, didn't look at the 10K, 10Q, no annual reports, no SEC documents, didn't even look at their social media, don't even know what the company does, what sector they're in. You're just, I see a lot of new investors just blindly buying the company. Oh, so-and-so on YouTube, said he's buying it, so I'm buying it. You never, ever want to do that. Anything that you buy, you always want to know what that business does. You always want to understand why you're buying that company, why you believe in that company, how you think they're going to do well in the future, and why. You want to know their management, how well you think their management is going to run that company. And, you just want to take a whole bunch of different factors into consideration before you buy a company. Every single company that I have in my portfolio, and I have like 20, 30 different stocks, every single company, I know exactly what they do, why I'm buying them, why I believe in them, and more importantly, when these companies dip, I buy more. Which brings me to my next point, which is you always want to make sure that you manage your risk. So that's number 2. You always want to make sure that you manage your risk and you never buy all at once. So what a lot of new investors do is whatever stock they find, they put all their money into it all at once. And then when it dips, they don't have any money to buy the dips. So then they get nervous, they get emotional, and then they panic sell. You never, ever want to do that. What you want to do is whatever stock you like, after you've done your due diligence, after you've done your research, you buy a little bit of it. So let's say you got $500. Whatever stock you like, just put like $50 or $75 into that stock. Even if you can only buy one share, that's fine, because stocks are naturally volatile. That's just what they do. They're going to do the roller coaster thing. They're going to go up, they're going to go down. They're going to have up days, they're going to have down days. So you never want to buy a stock all at once. Just slowly do this method, which is called dollar cost averaging in. Just dollar cost average into the stock. Buy like 1 or 2 shares, depending on how much money you have. And then once it dips, leave that money on the side so you can take advantage and buy those dips. And then the number 3 thing that I want to say is just really understanding the importance of patience. When it comes to patience, when it comes to a company, you always want to make sure that you give the company time to grow. If you buy a stock and it goes down the next week, that doesn't mean you should be selling. This is investing. Companies have to grow. You have to give companies time to execute their plans, their long-term goals, grow their revenue. If you're investing in a startup EV company, you can't get mad if it tanks next week. You have to give them time to build factories, get their plans together, make car sales. There's so many different things that you have to let them do. You got to let these companies grow and develop. So the third thing is just a lot of new investors just have zero patience. They want everything to be 100% in one day like it was in January of 2021. And, that's just not normal. That's not how the stock market works. you really want to invest the way Warren Buffett does. You find a company that you really, really believe in and you hold it for years. That's actually how you really make money in the stock market. You can make really big money doing that. That's why I'm more of a fan of being a stock market investor rather than a trader. So that's it. Hope this video helped. I'm going to go ahead and shut up now. I think I've talked for enough. So yeah, definitely feel free to like, share, subscribe, and I'll see you guys in the next video.